Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: commodities, wealth building, and or financial topics that I like to cover and that I like. That's a mouthful. And I like to make comments on. So let's dive in here. Let's see what's going on in social media. I'm probably going to interject a little bit more than just social media here. We might dive into some areas of where I think we're at in the bull market, which is very important as I get a lot of questions about how much upside is left, where are we at in the bull market, and maybe I can clarify that a little bit, maybe touching on oil or something like that, because I am an oil bull. Let's dive in here and let's see what's going on. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, I dive into a lot of training, finding individual companies, sectors, ideal buy points. You can see what I'm doing when I'm buying. I'm pretty hardcore about this stuff. Since I stopped working my 9 to 5, I'm basically doing this as a living, uh, getting dividend income and getting good entry points into these companies to make outsized returns. We still have the coupon code LEAP going on, LEAP. If you'd like to try it out, 50% off the first month and a discount on the yearly membership. All right, so going in here, we got Trend Spider. Do I smell a rotation? Technology sector ETF saw its first monthly decline relative to the energy sector ETF since September of 2023. And here we are, we came up to a top, and you can see that we are coming down. We've got resistance through here. That's what that dark black line is going across. We fell below it and then came back up, tagged resistance, and are selling back off. This is the technology sector, XLK, versus the energy sector. So when this ratio goes down, energy stocks outperform. I'm going to dive a little bit deeper into this. Let me pull up XLE, and then we'll go into oil here. So this is XLE. I'm going to get off logarithmic real quick. XLE is breaking to the upside. As you have learned, there's some things I look at in those technical analysis training things and what I go over during the question and answer sessions where it kind of defines this even better than what I have. But look at this, guys. We are breaking out. Oops, I've got it on the wrong deal here. We're breaking out to the upside here. That is huge for XLE. Here we are breaking out to the upside. It's a clear break here, even on the dailies, on the weeklies. It also looks very strong closing last week. And we're starting to clear a lot of these upper areas. You can see the green line going across. So what this means is that we are breaking away from the consolidation that we've got. This was all a consolidation. Last time, think of it as we are located here, breaking out. And you can see that we came back and almost did a retest. We did a full retest there to the bottom there. And that was the slingshot move to the upside. Hit our head on some resistance, and now we're starting to break through that resistance. Another thing I want to cover here is US oil. So this is the WTI crude price. I want to back out, zoom in here a little bit, go to all. So this here is there's three distinct consolidation areas. Consolidation 1, consolidation 2, consolidation 3 that we are in. Advancement move, advanced move. Now I'm going to scroll in and we're going to focus on the last two bull markets or last two consolidations, I should say. So let's focus in on this. I'm going to zoom in a little bit on this. So this is how it works. We've got the downtrend line, the downtrend line. This is the first wave. This is the first wave. We break through the downtrend line, which is the break here and break here. We come back to a retest, come back to a retest. And then wave 3, wave 4, wave 5. So if I were to take this and overlay all of this, we can get some potential numbers here. So I'm going to use a forecasting tool. This is the fractal that we got. There it is. And I'm going to put it right here. Now I'm going to overlay that fractal and show you what it looks like. The fractal would look like this if it were the same size of this. Now, am I 100% certain that this is going to be the size? I don't know, but I get a huge valuation number of over $1,000 a barrel at the potential peak. Now, what if I just take the third wave, put it to the top, and then put it on top here, like this? Then I get a number around $400 a barrel, because this might be too stretched for how low it went in 2020 of a negative number. So if I just take the third wave, put it right where we're at, basically on top here, I get a $400-ish price per barrel, 380. That's probably a high likelihood. And then we'll go into maybe another consolidation period where we consolidate sideways like this, and then we pull back. So is that possible? Yeah, that very well could be. I could also take the bars pattern here, grab this one from here to here. That was also another move from top. That puts us in the $900 range. If it were just like the 70s and I put it on top of the breakout going sideways. So somebody could justify anywhere of a top somewhere around 2030 of something like $350 all the way to maybe even $950,000. I don't know what's right. We'll obviously find out as we go. And I think that we're at the beginning of wave 3, which is here, and which is where we're at right now, when compared to history. So that's my opinion there on crude oil. And once portfolios have adjusted to the upper end of their risk limits, markets become vulnerable to a reversal. Our concern is that the reversal will have more in common with 1987 than any of the other crises in the last 30 years. The only thing I'll say there is a lot of these guys are very financial driven. They don't really look at the real estate market. And when you look at the real estate market, 1987 is past where we are at today. And I think we're more like the year 2000, 2001, something like that, where we have a tech bubble going on. We're at the beginning of an expansionary phase of real estate, and they're going to lower rates when the stock market feels pressure to go lower, whenever that's going to be the case. They're going to lower rates, and then they're going to send real estate to the moon. Whether that's on purpose or not, I don't know. It says, today I see a closely coupled financial system sensitive to pro-cyclical liquidity, in which the largest investors tend to want to move in the same direction at the same time. And that's what he's talking about, the big potential reversal, if everyone moves at the same time based off liquidity. Liquidity is driving this market. We can see everything going up together. That is impossible unless liquidity is coming into the system in good quantities. You cannot have everything and all valuations go up at the same time. That means that more money is in the system in order for that to occur. Otherwise, if a sector goes up, sector A, let's call it, sector B or C has to go down because it's drawing currency from another sector. If they all go up at once, then you've got inflation in the system. You have more money chasing fewer things. That's one of the reasons why I incorporated ratios, is to basically see through the inflation in the system. So this is what I mean by inflation and what I think is kind of curious. We have PayPal here. continuing to develop in stage one. Stage one's a base. The stage analysis technical attributes score it is currently at a 6 out of 10 and is sitting just below the potential stage two breakout. Where this is basically a stage two in PayPal. PayPal is a technology financial company. Then we start coming down. We're seeing that small caps printed a new 52-week high Thursday and finished the week above quarter one 2022 high. So we've got small caps that are also breaking to the upside. But we just looked at XLE and oil. XLE is breaking to the upside. Well, how is Nvidia all the way up at all-time highs? How is SMCI? How are small caps breaking to the upside? And oil and a lot of these other sectors are starting to break higher. That's liquidity in the system, guys. Liquidity is overpowering anything else in the system. Andrew Jackson was added to the $20 bill in 1928. Today's $20 bill is worth $1.12 in 1928 money. This bill would need to be changed to $356 to have the same value in 2024. And that was really mind-boggling when you price it in today's dollars. A lot of people struggle with inflation. I like seeing it. I don't like seeing the $20 bill is worth 1.12. I like seeing a $20 bill has the same purchasing power, or probably even less because it's probably fudged inflation numbers, of $356. What if a $20 bill today, or $20 back then, is the equivalent of $500 today or $600 today? I mean, think of how mind-boggling that is. It's just ridiculous. Trend Spider, it says, here's how the major index ETFs performed in quarter one 2024. We've got the SPY up almost 11%, Q's up 10.3, IWM up 5.4, and DIA up 5.5. And a lot of our commodities, energy was a top performer. There was hardly anything that was down in the first quarter of 2024. If that's the case, we are looking at things in nominal terms, and we've got massive inflation. Nominally, everything is going up because there's too much money in the system. Liquidity is coming back up. That's what I'm trying to paint the picture here. So you have to start looking at ratios to see what's outperforming what. You can't just look at this and be like, oh, I'm up 5.5%. Yeah, but you can buy less SPY. You can buy less energy. You can buy less copper, less oil, less platinum, less gold, less silver. I mean, all of that's going to be less. So that is where you have to be looking. How are you maintaining your purchasing power? Feel like you've missed the train on GLD breakout. This 4-year triangle from silver looks ready to rip. And I agree with this. This thing is ready to rip, guys. Do not miss this. Get it on your radar. Watch it. Learn from it. This will also activate what I think will be a 50-year chart break on a cup and handle. These don't come but once every 50 years. You can't mess this up. You got to get it right, in my opinion. So silver could do some phenomenal things going forward. Here's Nvidia. Nvidia monthly channel breakout is a thing of beauty. Nvidia rallied 88% in the first quarter of 2024. That is ridiculous. And we're probably doing a false breakout, but we'll see. All of these tech stocks and now all of the commodities are running together. How is that possible? Inflation. Inflation. Google. Look at Google. Ready to break out here on Google. How is this possible? Google monthly rounding bottom setup, trailing PE still at relatively low levels, one of the strongest Mag 7 setups heading into April, breaking out to the upside. How is all of these things breaking out? Inflation. That's why gold's going up so much. Here's Christine. She says, despite what we've all been told about doing more with less, higher oil IP, longer laterals, frac density, higher horsepower, etc., etc. There was no first 6-month oil EUR uplift year over year, and 2021 remains best for the Permian. They do have more natty or natural gas. So the 6-month crude oil production, if you look at 2023, it is not higher than 21 and 22. So we are falling in production as time goes on with oil production out of the Permian. Investing is 20% managing your money and 80% managing your emotions. I agree with that. It is a lot of this is managing your emotions and how you can stay long and not do anything to mess up your returns in your portfolio. One of the things that emotions do drive is over trading. People trade too often because they get too afraid or they think that the stock has gone up too much and they're not focusing on the value that's being created by the underlying business that is behind the stock. They let the stock movements control the emotions and not the value judgment on the business, which should be controlling your decisions. Another one is 100K a year is not a lot of money, says Billy, 22, who makes $40,000 a year. Still like a lot of steel names these days. Here's Nucor, and I like steel too, and that's breaking to the upside. And again, how are all these things all breaking at the same time? We have tech, S&P, small caps, large caps, oil, steel. A lot of things are breaking to the upside. Inflation. Here's Sophie putting in a bottoming pattern. That inflation's starting to head into everything. And we could see a potential bottom there. A key chart for the next few years, this is Dow equals 1 here. It says, silver is going to melt faces when this bull flag breaks out. Expect new all-time high, and we're right there, ready to break out on silver. I do very much like this, and this is a bullish setup where you've got basically a flag or a megaphone pattern. A lot of the times on the megaphone pattern, when it's ready to break out, you start hugging the upper trend line just like it is there. That is something that we do see. And again, the 2-year weekly chart in silver junior mining ETF, SILJ, we may very well have broken the long-term downtrend. And there we are breaking out of this long-term downtrend. Silver is still ready to break, but sometimes you see positioning in ETFs and some of the mining companies before the breakout. This is a good thing to be seeing this breakout in SILJ, even before silver breaks out itself. This is incredibly 5.5% is still the magic mortgage rate to convince homebuyers to purchase. We've asked the question 3 times now, March, September, and March 24, and the numbers just haven't budged. No surprise that builders have seen success buying down rates into exactly this range. So the highest acceptable mortgage rate for a new home purchase. We've got a lot of people wanting to buy homes, and they are not budging from the 5.5% where you get a large uptick in buyers. If rates do fall down, we have a lot of buyers that are willing to buy if rates are somewhere in this range. So I wanted to show that to show you how much support is underneath the market. If a slowdown in the market does occur and rates drop, it's going to drop right into these home buyers and the affordability of these home buyers. Here is a dot plot. So it says if you wait for interest rates to come down by another point, I don't think you'll gain. I think you'll wind up paying more because I wouldn't be surprised if real estate went up by another 8 or 10% if interest rates come down, says Barbara Corcoran. Now, this is the actual data. So changes in mortgage interest rates and changes in home prices are weakly related. The relation, as weird as it seems, is that home prices go up as interest rates go up. And then during a crash, what occurs is you'll see a decline in interest rates and home prices at the same time. So the cycle, how this works, is mortgage rates will drop in the beginning of a cycle. You'll go to this left-hand side over here, and then it will work its way on up this way. It'll come up, come over, and then cycle back down quick like this. And then we come back over. So we cycle like this through this. The crash occurs when rates and home prices go down together. A lot of the times there's a weak correlation between home prices rising and interest rates rising at the same time. And I think people have it completely backwards. They think that when interest rates go down, home prices go up. That is not right. The interest rates go down because home prices have crashed and they're trying to stimulate demand again. That's generally, I think, the right mindset. Again, crude oil futures, former resistance turning into support as money continues to rotate into energy and energy stocks this year. And we're ready to hopefully rip here in crude oil futures, which is that support zone that we're bouncing off of. We've got very big picture. There's a massive divergence between gold and silver. Last time the two had a larger divergence like this, silver played a catch up big time. And this time silver will break out of the 43 plus year cup and handle. So the overshoot this time should be absolutely mega. And silver's got this big catch up move to do if you were to basically zero this out, the two prices. So it's been underperforming gold. Gold's been taking off. That is your big ratio divergence. This is the big ratio, and everyone's talking about the ratio catching back up to a more normal level. The normal levels you can see is when the red overlaps the orange. And that's what's going to happen. The ratio is going to compress. We're going to get an outperformance of silver against gold in this bull market. And then at the top, we're going to swap our silver to gold. At least that's what I'm going to do. The stud here, many ask me why I'm bullish on natural gas because charts are so bearish. Same reason why I believe in Trump 2024. I believe in God and good over evil. Regardless, when new rising cycle starts on bigger time frame, big moves come hard and fast. We're at the bottom of a cycle here. And this is a good time to be looking at natural gas because we're probably going to bounce and move on up, just like this has occurred every single time in this cycle. So I agree, natural gas does look good and it is cheap. We've got energies improving a lot, should be in the leading team soon. So leading is the upper right quadrant. We are in the improving quadrant and we will eventually cycle over to the leading. Most other sectors are cycling back to lagging. And we're going to start sucking the money from the lagging companies into energy. I like it. Leonard, a home builder ranked number 119 on the Fortune 500, is presently promoting an FHA buy down program featuring a rate of 3.75% in year one in Colorado and 4.75% for the balance of the term. This is how they're getting the buyers to come in, is they're increasing the affordability for first-time home buyers. And that's where we're going to end it. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. We still have that LEAP coupon code going on. And that's all I've got for today, guys. So we'll catch you later. This is Finding Value.